Hello everyone, welcome to another weekly chapter. This chapter is going to be specifically about quarterly shifts. Now, this is an important time related concept. It's a higher time frame concept used to build a narrative or effectively generate trading ideas on new higher time frame biases. Now, as ICT or CRT traders, we believe that the markets run by an algorithm, right? Or the markets run due to an algorithm. And the moves that we see in the markets are not random at all, right? The reason we believe in this idea is because if all the moves in the markets were random, then the things and the concept that we've learned and that had worked in the past based on our data would have absolutely no chance and no guarantee of effectively working in the future, right? Because if something is completely random, there is zero chance that you can turn that randomness into an edge that could effectively bring you profits for the long run, right? And the probabilities of that working out will never be in your favor. That is not possible with something that is random, right? That would be deemed as gambling. You can never take randomness as an edge, and our job as a trader is to find something or to find sequences or themes or patterns in the markets that brings us an edge, and that's only possible if the markets are run by an algorithm, right? If we believe that the markets run through a specific algorithm, right, then that means that the market moves through certain sequences or specific rhythms or themes. And if that we could collect huge sums of data, we could find a particular sequence in the markets or a particular pattern that works over time and that runs the market. And if we could effectively identify that with some little margin of accuracy, we could eventually turn that into our favor, and that would then be considered our edge, right? That's what an edge is. Now, it's not entirely possible to be able to identify all the sequences and all the phases in the markets, right? Or simply, it's not it's not possible to identify or to determine how the market moves completely, or how to identify every single swing in the markets, because the algorithm that the market is moving with is evolving constantly, right? And it's a really complicated algo, and that's completely fine. You have to accept that you cannot entirely outclass or outsmart the algorithm, right? The chances of that happening, or the chances for that, are zero, and it's impossible. But what you can do is identify certain and specific sequences in the markets that works at times consistently over a huge track record of data. And then based off that data, you can then set certain rules and protocols for yourself with which you can potentially exploit that sequence that you've identified in the market side. And then you're going to use the correct risk management for it. And in the long run, what you have to believe what you have to do is believe and trust your system, follow your plan, and over a long track record of data, you'll always be profitable, and you'll always end up with profits, right? And that is because you have identified an edge that had worked in the past consistently, and you've collected data around it, and that data shows that if you use the right risk management and use the right risk to reward ratios, you will consistently end up with profits at the end of each month, each quarter, or each year, right? And that is exactly how ICT, Wyckoff, Larry Williams, or any great trader have come up with these concepts, right? If we think order block works, then that's because ICT identified that sequence of order blocks and collected data around it, which showed that over a long record of data, order block always work when they have those specific characteristics, right? And they work more often than that. That's how ICT came up with it, right? It's not like he was born with that knowledge. He actually cracked that up is by actually learning from other previous great traders like Larry Williams, Wyckoffs, and then using their teachings to refine the knowledge even more, and gaining chart time and chart experience, and seeing all of these things happens in the markets over and over again. And that's how we identified that if a certain candle or if a certain price action has these characteristics, it would be deemed as an order block, and then it would work like this, and it will have these specific outcomes, right? That's how ICT or any other trader came up with these concepts or the concepts that they've got, right? And the same can be said for other concepts as well, right? Like if we believe that quarterly shifts work, then that is because ICT has identified this sequence and identified this concept uh, and his data, and he's collected data around it, and based on that data it is proven that this edge that ICT has identified or that ICT has came up with works in the long run, right? And that's why we trust and believe in these concepts, right? And as I said before, the only way it's possible is if only the markets are run due to an algorithm, right? But if the moves are random, then it wouldn't have been possible for us to identify these patterns or these sequences. Now, another thing is that obviously you cannot be correct 100% of the time, right? But the thing is, with these concepts, you're going to be correct more often than not, which is what matters to us as traders, right? You can never have a perfect system that always give you the right signals or the most accurate signals, right? You will always have losses and wrong analysis, and they're inevitable. You cannot avoid them, right? And that's completely fine. You have to be content with it and accept that it's a part of the process, right? Now, along with that, you will also have to think in terms of probabilities, right? Because the edge will always have some margin of inaccuracy, or simply it will lose sometimes, right? And give you wrong signals that will lose you money in trades. But as I said before, that's completely fine, because you know that no system is perfect, no edge is perfect, and it will always have losses, right? These losses are inevitable. Now you can never know when will these losses occur, right? You cannot skip a trade that your model or edged offer because apparently you feel like this is going to lose, right? There's absolutely no way that you can know that the next trade could be a winner or loser, right? It's up to the probabilities, right? And for that reason you will always have to think in terms of probabilities, and always think in terms of long-term performance rather than short-term losses or short-term setbacks, right? Thinking in probabilities and then accepting the probabilities is the best way you'll be able to trust your system. You will also have to believe that all of the losses and the wins of your system are oddly distributed, right? Randomly distributed, with absolutely no way of knowing what the distribution is going to be, right? For example, if your model has a 50% win rate, right? Now if you're asking how can you identify that your model has a 50% win rate, then the answer to that is the huge sums of data that you've collected from the past, right? That particular number of that 50% about your win rate is derived from the data that you collected about your model. So if your model has a 50% win rate, then that means is that according to the years of data that you've collected for your model, all of the trades that you took in that particular time, or that your model offered in that time window, all of the trades that your model offered, half of those trades were losses and half of those trades were win, right? So based on that data, you derived or you found out that your model has a 50% win rate, right? Now you can't decide it with just a few weeks worth of data, right? You must have at least 2 to 3 years of data before you could decide what is your win rate of your model, right? So now, if you had taken 100 trades, then 50 are going to be wins and 50 are going to be losses based on that metric, right? Now, before you get ahead of yourself and start thinking that how is this profitable, then let me tell you that this is just a hypothetical scenario, right? And even this win rate is more than enough to be profitable and consistently profitable, right? Because not only you have to take win rate into consideration, but you will also have to include or and consider the risk to reward ratio edge as well, right? So now you know that you will lose 50 trades out of 100, right? Now what you can never know is whether you will first incur losses or wins, or how the distribution of these losses and win is going to be, right? That's entirely impossible, and it's up to probabilities, right? The distribution of losses and wins are completely random and that particular set of data, right? Okay, enough of that. Let's get back to the chapter and let's discuss quarterly shifts. So, first of all, I'm going to start with the introduction to quarterly shifts, and then we're going to explain it further even more in the next part of this chapter. So, the first and foremost and the most important thing that you must consider while dealing with quarterly shifts is that it's not a standalone be all end all concept, right? It's rather a tool or idea that can be used as a confluence in conjunction with the other high time frame concepts like seasonal tendencies, key levels, dealing ranges, market profiles, and so on, right? First of all, you have to consider that you cannot use this concept alone on its own. It has to be used logically and it has to be integrated with the other concepts in conjunction, and only then you will be able to see how good quarterly shift works, right? It's going to be used to first of all gain conviction in the already existing trading ideas, and then in some cases you're going to even use it to generate new trading ideas or new biases on the higher time frames. But you're only going to do that in certain cases when everything is aligned with each other in a logical fashion, right? Now you may ask, what actually is quarterly shifts, right? Now first of all, what you have to make sure is that you must not confuse it with quarterly theory, right? We're not talking about quarterly theory here. We're talking about quarterly shifts, right? I have no opinion on that theory, quarterly theory, right? I've never tried it, but all I would say is avoid it because it's not worth your time, right? These ICT and CRT concepts are more than enough, right? And are more than enough for you to become profitable, right? And if you use any other concept from any other person, right, and then it will just bring in more variables and your analysis would become much more complicated, right? It's only gonna make things worse for you. So only stick with the things that ICT and Lumio has taught and forget about the others, right? They're not worth your time. Now let's talk about quarterly shifts. So the idea or the core idea of quarterly shifts is that every 3 to 4 months, right, there is a significant or major structural shift or change in the markets, right? Now this shift or this change could occur or be perpetuated in multiple forms, right? But the idea is every 3 to 4 months, either 3 months or 4 months, right? It could be just 3 months or it could be 4 months, whatever, right? But that's the range, right? It cannot be higher than 3 to 4 months, right? It can be higher than 3 to 4 months, but the optimal range is 3 to 4 months, right? Depending on the scenario and the situation you're working with, each 3 to 4 months there is a structural shift and a major change and the profile and the order flow in the markets, right? That is the core idea of quarterly shifts, right? Now obviously it doesn't end there, right? It has a lot of other intricacies and a bunch of important aspects to it which we'll discuss in this video, right? So it's not that simple, right? Don't get ahead of yourself. Now what this concept also suggests is that the markets operate within a particular or specific market profile or structure or order flow for only a maximum of 3 to 4 months, right? It cannot go any longer than that in a particular profile or a particular structural order flow, right? Now obviously you have to remember that it's not going to be like this 100% of the time, right? but more often more often than not, and most of the time, you will never see our market moves in a specific or a certain market profile or a certain order flow for longer than 3 to 4 months, right? Now, if you look at the monthly chart and the weekly chart, you would see that it's actually true, and the markets do indeed move like this most of the time, right? And almost all of the time, this stays true, right? Not all of the time, but most of the time, it stays true, which is what we call lineage and which is what matters to us, right? Now if you pick up the times that it did not work and start using it as a lame argument against it, then that means you are clearly not thinking in terms of probabilities, or maybe you skipped the first part where I talked about it, right? So if you skip the first part, then go back and watch it and listen to it again, right? Another point is that these 3 to 4 month periods are not based on calendar months, right? But instead, the quarterly shifts begins or ends from the start of the most recent month, or from the start of the most recent month where a new structure or a new market profile emerged or started, right? For example, a quarterly shift does not have to do anything with the quarters of the year, right? It doesn't work like that. It doesn't imply that each quarter we're gonna have a particular profile or structure, or then the next one is gonna start in the second quarter of the year or something, right? It doesn't work like that. It can start or end at whatever month of the year, depending on upon the price action structure in order flow, right? It doesn't have to do anything with the quarters of the year. It's not linked with that. That's what you must remember. Now let's move on and let me explain this even more. So the core idea of quarterly shift is that, as I discussed before, the the primary belief behind a quarterly shift is that approximately every 3 to 4 months there is a major structural change and shift in the markets, which means that the markets undergo changes every 3 to 4 months based on price action. Now, as I said before, it could happen every 3 months or every 4 months depending upon the price action, right? And you will see that in just a minute. Now, this doesn't mean that the market reset at all, but rather there is a noticeable transformation in the market profile's structure or order flow, right? Now, what this idea or theory helps us with is that when we have this idea in mind, we can anticipate changes in market profiles or the order flow at specific times of the year, right? Which means we would be using time and we would be timing trends and profiles in the markets, right? And obviously, it's not going to be random at all, but instead we'll be using it with the other concept, right, which we'll also discuss in this chapter. If the market has moved in bearish order flow for the past 3 to 4 months, then there is a high chance that now it can have a major structural change and it can transition into a bearish order flow if price tests a key level and there is maybe a SMT divergence there or so on, right? This is what this idea tells us, right? If similarly, if price has moved in a ranging profile for the last 4 months, then there is a high chance that this ranging profile could now end, because we know that according to quarterly shifts, a market more often than not never moves in a specific profile or a specific structure or a specific order flow for longer than 3 to 4 months. And now that this specific market has moved in a ranging profile for the last 4 months, then according to quarterly shift, we can expect with a great deal of accuracy and with a great deal of precision a major structural change, and now we can expect an expansion profile and significant moves with a great deal of accuracy, right? That is what quarterly shift is. Now, obviously, as I said again, you cannot use this idea alone, but obviously you will look for the other concept, like you will look for key levels, SMT divergence, seasonal tendencies, and so on to support this idea. And if there are enough confluences that are aligned with each other in a logical fashion around a logical framework, then you can expect a change in the markets, or even expect or anticipate the tops and bottoms in the market with a higher margin of accuracy, right? And your higher time frame analysis would always be on point. Now, quarterly shifts also enables us to make much more informed and enhanced decisions about the structure and market profiles on the higher time frame. And last but not least, with the help of quarterly shifts, we can time the markets, right? We can identify timely trends and timely profiles in the markets, which means we're going to be using the time aspects of the charts, right? Now, moving on, each 3 to 4 months period is marked by a dominant market profile and structure, meaning that that particular time period the market moves in a certain structure, right? For example, bearish, right? And then after that it shifts to another structure for the next quarter or 3 to 4 months. The market moves in such a predictable manner and fashion, with its price action aligned with structural framework that you would have built with the other concepts, right? Like seasonal tendencies or SMT divergence, etc. Now, with the help of this, you can build new biases or even generate new higher time frame ideas or frameworks, right? For example, if you see that the last 3 to 4 months were bearish, right? And price consistently formed bearish price action. And now just last month we changed the structure into bullish because price tested a key level and it had a major SMT divergence which suggested non-symmetry. And according to non-symmetrical conditions, the current price action is unable to continue, and that's why we had a major structural change, right? Then the next 2 months you can have and you can keep a bullish bias because the last 3 months were bearish and now this new quarter is going to be bullish. So for the next 2 to 3 months your directional bias is going to be bullish and you're going to be right about it, right? You're going to be accurate and precise about the higher time frame bias and the higher time frame directional bias for the next 2 to 3 months because of quarterly shifts. Another important thing that people get wrong about quarterly shifts is that they link it with calendar quarters, right? Which is the worst way to approach it, right? It doesn't have to do anything with calendar quarters. It is dynamic and is based and dependent on price action and seasonal tendencies, right? A quarterly shift can occur at any time of the year. It has nothing to do with the calendar years or the calendar months, right? The calendar quarters work only when you are dissecting the yearly range with the open high low close concept, right? And you're treating each quarter as a distinct phase. But in quarterly shift, you have to look at the current in previous price action and decide it based on that, right? It's dynamic. For example, if a new market structure or order flow begins in February, right? Meaning, let's say the last 3 months from November to January were bullish, and now in February we had a structural shift in price action, right? Then based on this, you can expect the next shift to potentially happen and continue till May, right? And then you can expect the next shift to happen around May or June, considering the conditions are favorable, right? And that way throughout the time period from February to May, you could trade in a specific profile in a specific direction, exploiting the idea of quarterly theory, or quarterly shifts, right? Now the flexible timing is based on when a notable and a significant structural change or transition occurs, right, rather than adhering to fixed calendar quarterly boundaries, just like I said before. Now, let's talk about how to accurately use quarterly shifts to use it as a confidence, right? But like a major confidence, and also how to use it to generate higher time frame ideas and biases at times, right? Obviously, just like any other concept, the best way for them to work and the only way that they're gonna work is that when they are used in conjunction with other higher time frame concepts in a logical fashion instead of using them alone or whatever, right? Because if you treat any of these concepts as standalone be all end all concepts, you're essentially pattern trading and not using logic, right? But if you use them together and actually build cohesive narratives that actually make sense, then that's what logical analysis and logical trading is, and you'll be using it the correct way. Now, the concept that you're going to use together with quarterly shifts are seasonal tendencies, right? Seasonal tendencies is the first and the most important one, right? You're going to use this. The second one is high time frame SMT divergences, high time frame key levels, high time frame market profiles, and dealing ranges, and so on, right? These are the different important concepts you'll have to match with quarterly shifts, generate ideas, and to generate new biases. Now I'll be showing you each one of them in this chapter, right? I'll be showing you how you can combine it with each one of these concepts, right? Now, for instance, seasonal tendencies provides us with insights to what could happen at certain times of the year, right? Now, the way how quarterly shifts are gonna help us when combined with seasonal tendencies is that we can use it to predict or anticipate major structural shift or major quarterly shifts at particular times of the year, and that way we can time certain profiles and certain trends in the markets. It can essentially show us when the seasonal tendencies can assert themselves more strongly. So let's move on to the next slide and let's discuss the framework around quarterly shifts a bit more. So we know that if a market has been moving in a specific market profile or a specific structural order flow for the past 3 to 4 months, then it's highly likely that that specific profile or that specific order flow is going to end soon, and we're likely going to have a structural shift or a major shift in the market over the course of the next few weeks, right? If an asset has been moving in a specific market profile, for example, a consolidation or a ranging profile for the past 3 to 4 months, right? Then based on quarterly shift, we can anticipate an expansion profile over the next 3 to 4 months, right? Because the most likely outcome after a ranging profile is an expansion profile. You're going to make sure to use the basic fundamental principles of market profiles as well, right? And match it with key levels accordingly. Similarly, if the market has been moving in an uptrend or showing bullish order flow over the past few months, then based on that, we can expect a shift towards bearish or ranging order flow in the upcoming time or the upcoming months, right? Because we know that according to quarterly shape, a market never moves, and more often than not, a market does not move in a specific profile or a specific order flow longer than 3 to 4 months, right? And after each 3 to 4 months, it always has these quarterly shifts in which it changes into other structures or other order flows, right? Similarly, you can also look at it in this way. For example, if the market has been in an bearish order flow for the past 4 months, but last month the order flow shifted to bullish, right? Then you can anticipate continued bullish order flow for this month and the next month, because it's signaling a bullish quarter, and your directional bias is going to be higher, right? Using quarterly shifts helps us in two major and significant aspects of our analysis. First of all, it helps us accurately determine our high time frame drawn liquidity, and second, it helps us in building high time frame narrative and generating a directional bias on the high time frame. Like, these are the two most important aspects of high time analysis, and right, and quarterly shifts helps us with both of these aspects. Now, at times it will be used as a confidence, but other times you can also use it to build and generate directional biases and new biases as well, right? Now, let's talk about the most important part of this chapter, which is how we're going to integrate quarterly shifts with the other concepts. Now, as I said earlier, you must integrate quarterly shifts with the other concept for it to work accurately, and we're going to learn about it in this part of this chapter. As I said before, it works best when it's used in logical fashion around a logical framework with the other concepts, right? And with the help of this, we can create sharper narratives and a lot more accurate and strong higher time frame directional biases. The different concepts that we're going to integrate with quarterly shifts are market profiles, seasonal tendencies, key levels, SMT divergences, and dealing ranges, right? I'll be discussing most of them in this chapter. So, right here, first of all, let's discuss how we're going to combine quarterly shifts with market profiles in order flow, or simply advanced market structure, right? Now, we know that both quarterly shifts and market profiles have specific ideas and principles, right? And in the same way, right, in the same way, order flow or market structure has also some fundamental principles that it follows. Now, what we're going to do is combine them all, but we'll also stick to the fundamental and basic principles of each concept while maintaining a logical approach, right? For example, we know that after a ranging profile, the most likely outcome for price is an expansion profile, right? Similarly, we also know that after reversal profile, the most likely outcome is an expansion profile, right? In the same manner, we know that the basic principle of order flow, right, and how they work, right? And we know that we'll be considering them all in our analysis while combining it with quarterly shifts, right? We will not ignore the basic principles of these other concepts, like order flow or market profiles. We'll consider their fundamental ideas as well. Now, we know that every 3 to 4 months there is a quarterly shift in market profiles and structure, and the whole dynamics of price action transitions and shifts to another framework, right? While anticipating the next market profile or structure order flow, we'll be using the same basic principles of each concept. For example, if the last 3 months have been bearish, right, then the next few months will be bullish, right? Meaning we'll have a bullish next quarter and vice versa. If the last 3 months have been a consolidation or a ranging profile, then we can expect the next 3 months to be an expansion profile, right? Obviously, the way we're going to decide this is by also using and looking at the key levels, right? And using all the other price action tools as well, right? We're not going to be blindly doing this, but instead we'll also be using all those concepts together as well, right? Now, this is just the first step of the process, right? We've got other steps too, which we'll discuss in a minute. Another example would be if the last quarter was an expansion profile, and with that expansion profile we tested a higher time frame key level, then the next profile or the next quarterly shift that we can expect in the following months is going to be a reversal profile in the opposite direction, right? Combining market profiles in quarterly shift, we can anticipate and expect a reversal profile in the opposite direction over the course of the next few months. Right, here is a graphical representation of it. You are seeing these three quarters right here outlined in the gray, red, and green rectangles, right? Now, first thing you must remember is these uncalendar linked quarters, right? These could be any 3 to 4 months of the year, right? It could be from February to March, March to June, or it could be any 3 to 4 months worth of time or time window, right? With the right quarterly framework. You can see the first quarter was a ranging profile, right? Meaning these 3 months we did not do anything significant at all, and we just mostly consolidated, right? Now, based on the principle of market profiles, the next likely outcome after a ranging profile is an expansion profile, right? And also, according to quarterly shifts, we know that no market spends more than 3 to 4 months in a specific profile, and it always changes and shifts to a newer each 4 months, right? So combining these two ideas together, we conclude that after this quarter or after these three months or 4 months of ranging price action, we can expect the next 3 to 4 months to be an expansion profile. Now, obviously, we combine these ideas with each other, but before we can anticipate a next profile or transition, we'll have to wait for some sort of confirmation on the lower time frame, either in the form of a lower time frame CSD, right? A lower time frame change in state of delivery, or change in the order flow on the lower time frame, right? And that way it would confirm that the structure has actually changed, and now we can expect a structure or a major shift on the higher time frame, right? Or we can expect a transition. If you do it blindly, then it won't work for you, right? You'll also have to dig through the lower time frame and look for change in structure, change in dynamics, or change in order flow, which would suggest that the quarterly shift has now occurred. And then for the next 3 to 4 months, you can continue to look for ideas and trading ideas and that particular direction, and you'll have a clear directional bias, right? Now, moving on, right here you can see that similarly what happened is that the next 3 months price print in an expansion profile, right? Now we know that the likely outcome after an expansion profile is either a retracement profile, a ranging profile, or a reversal profile. Now we cannot for sure know which one could play out unless and until we combine it with key levels and dealing ranges, and then we can expect a great deal of accuracy. So let's say in this case, price action tested a key level in this expansion profile right here, right? Somewhere here, right? Then based on that, if an expansion profile has tested and it had been in an expansion profile for the last 3 to 4 months or the last quarter, then we can expect a quarterly shift in the opposite direction, and we can expect a reversal profile, right? Based on the ideas of market profiles and quarterly shifts combined with each other. And obviously, before we could expect that quarterly shift, we're gonna go down to the lower time frame and look for a structural change or something on the or a confirmation on the lower time frame before we can conclude or make that verdicts or decisions, right? Now, similarly, if in this case, if we hadn't tested any key levels or anything, then the likely outcome for the next 3 to 4 months for this quarter or for this last quarter would have either been a retracement profile or another ranging profile, right? That's how you're gonna approach it. We've got another example right here. You can see that we've got these three quarters and these three quarterly shifts, right? You can see that the first quarter from February to April, it formed bearish price action or a bearish order flow, meaning price has been moving in a bearish price action for the last 3 to 4 months. So after this quarter, we can expect a structural shift and a change to the other side for the next few months. Similarly, let's say that price then had a major shift and changed, and price formed bullish price action for over 3 months, right? Now again, we know that this bullish price action is likely going to end soon because it continued for 3 months straight. And now we can potentially expect a structural shift and change again, and we can expect price to transition, right? Obviously, as I said earlier, you'll have to wait for a confirmation in the form of a lower time frame structural shift or a CSD or a testing of a higher time frame key level or whatever, right? Or a CRT or a Turtle before you make decisions, right? And that would then be an informed and enhanced decision. Here we got a real example right here. You can see that price consistently found bullish price action these last four candles, right? It's the monthly chart, so each candle represent a month, right? So price found bullish price action for over 4 months, right? Now according to quarterly shift, this bullish price action is likely going to end, right, if the conditions are right. And let's say with this bullish order flow, we tested a high time frame opposing key level, and we had also a lower time frame shift in structure. So based on these ideas combined, we would have expected the next 3 to 4 candles, right, to be bearish, or the next 3 to 4 months bearish, right? You would have anticipated and expected a structural shift, and our bias for the next 3 months would have been bearish, and we would have looked for bearish trades, right? And we would have been right about the directional bias, you can see. Now again, you can see what happened the next 3 months. First of all, we formed this CRT right here, price purged it, and then had bearish price action over the next 2 months, meaning these 3 months from this candle to this one, these 3 months were essentially bearish, right? And also along with that, you can see with these 3 months of price action, price also tested this key level in the form of this FVG. So first of all, we tested a higher time frame key level, which is this FVG. Second, the last three candles were essentially bearish, meaning the last 3 months price action from bearish order flow, right? And let's say the long-term drawn liquidity higher. So based on quarterly shift, right, we've been in a bearish order flow for the last 3 months, meaning the last quarter was bearish. So combining all of these ideas together, we can anticipate a structural shift now for the next 3 to 4 months to be bullish again. And you can see price did indeed form bullish price action in these 3 months, which means we would have been right about price about this quarterly shift, and our directional bias would have been correct, right? And we were this accurate because of key levels, quarterly shifts, order flow, and market profiles. Now again right here, you can see the last 3 months were bullish again, and let's assume with this bullish expansion, we reached the long-term drawn liquidity and price tested a key level. So based on quarterly shift, we can expect a shift for the next 3 to 4 months, right? Because we know that according to quarterly shift, price does not stay in a particular order flow or profile for longer than 3 to 4 months. And you can see after combining the ideas, a price did indeed form bearish price action over the next 4 months. Here is another way of looking at it. So last one, we looked at it in terms of structure, and now we will look at it in terms of market profiles. You can see price had an expansion profile for 3 to 4 months, and now according to quarterly shift, we can expect it to either form a ranging profile and a retracement profile, and you can see price formed this sort of ranging profile for the next 3 months and also tested a key level with it. So now according to quarterly shift, again the next 3 months we're gonna expect a structural chain towards the bullish side and expect an expansion higher again towards the higher time frame long-term drawn liquidity, which is higher, right? And then after reaching the long-term drawn liquidity with this expansion profile, we can also see that this expansion profile was 3 months long, right? So we can considerably expect a major structural change or structural shift, and we can anticipate a reversal profile now. And you can see price did indeed had a reversal profile for the next 3 months or the next 4 months. Here is the price action on the weekly chart. You can dissect everything and you can see how did it move. If you are a sharp observer, then you notice that the major CRTs were always formed at key structures, right? They were formed at higher time frame key levels and right when significant purges had happened, right? That's something to note down for your notes as well. Now let's talk about how to integrate quarterly shifts with seasonal tendencies. Now remember, I'm explaining all of these to you in a logical manner, right? And remember that the previous integration is going to continue to this one right here too, right? For example, the previous idea that I discussed, and I discussed how to integrate quarterly shift with market profiles and structure flow, that idea would be used in this integration right here as well, right? For example, right here I've written that I've written integration of quarterly shifts and seasonal tendencies here, but actually I'll explain it to you while also integrating the previous ideas that we discussed as well, right? Which simply means that it's not a separate process, but this right here is a new step of the last process, right? They are interconnected with each other. It's a step by step approach, right? So remember that, and don't treat each step as a separate process. So combining quarterly shift with seasonal tendencies is actually one of my favorite, right? Because when these two are combined with each other in a logical manner, it truly represent the time aspects of chart, right? You can actually feel and you can see that you are using time and your higher time frame analysis and trading ideas. What you can do is you can align bullish seasonal tendencies with bullish quarters at the right time period around the right frameworks, and it will always work like a charm, right? It really is a great confidence. For example, if the last 3 to 4 months were bearish, but the next months are seasonally bullish, then based on quarterly shifts and seasonal tendencies, you can anticipate a highly likely bullish quarterly shift, right? Because both ideas are pointing towards the bullish side, right? And price has been moving in a bearish price action for the last month, and this is likely going to end soon because a quarterly shift could occur, right? And also that idea is supported by the bullish seasonal tendency that we have for this particular pair, asset or instrument, right? And similarly, you can use the same thought process and ideas for other scenarios as well, following the same logical principle. For example, right here, this is the euro seasonal tendency chart, and based off of this data, we can see that EU or euro dollar has a tendency or a seasonal tendency to form bullish price action from October through till December, right? Till the end of the year, right? From October to December's end, euro dollar seasonal is seasonally bullish and form bullish price action more often than not, according to this seasonal chart. Now let's see if we can combine this with quarterly shift and anticipate quarterly shifts with a great deal of accuracy. Right here we've got this Euro USD weekly chart right here, and you can see that these two quarters. The first one in the gray area rectangle represents the price action from Euro USD from the last 4 months, where it consistently found bearish price action and went lower, and the second one is where it had a quarterly shift to the bullish side. Now you can have easily expected this bullish price action and this bullish quarterly shift, because first of all you can see the last 4 months were completely bearish, and according to quarterly shift, a particular market profile or a particular market does not stay in a specific profile or a specific order flow for longer than 3 to 4 months, right? And more likely what happens is that each 3 to 4 months it shifts to another profile or order flow. So we could have expected a bullish quarter or a bullish quarterly shift based on quarterly shift ideas, or based on this concept, right? So the first factor is quarterly shift, and the second is that we saw from the seasonal tendency chart is that from October to the end of year December, price usually forms bullish price action, right? And you can see that the October month starts right from here, and both the ideas perfectly aligned with each other at the right time, and we had a bullish quarterly shift right from the start of October, right? And we would have expected and anticipated the bottom of euro dollar from here with a great deal of accuracy, and our analysis would have been on point. You can see right here that we are finally using the time aspects of chart, right? And we are timing the markets and charts, right? Instead of just looking at the price, we are using both time and price, right? Now price in the sense that we are looking at key levels, order flow, market profiles, and then we are combining it with time concepts such as quarterly shifts, and seasonal tendencies, and based on that we are improving our anticipatory skills, and our accuracy is getting better and better, right? Now, as I said before, you're gonna also integrate key levels and other concept here with along with it, right? And your accuracy would be better than almost anything. And if you are a good observer right here, then you would see that right here at the end of this bearish quarter, we formed this bullish CRT and we used that CRT as a catalyst and a key level to drive price higher, right? These are the type of places where you're gonna find high probability CRT on the higher time frame, right? Like weekly, monthly, or daily time frames. Remember time and price. Here is another example right here. You can see again we saw that from October to December, EU is usually bullish and forms bullish order flow, right? We saw that from the seasonal tendency chart, right? Now, if you're wondering how am I choosing these quarters, then as I said before, I'm selecting the quarter from the start of the month where a specific profile of structural order flow started. And right here you can see that the bearish price action started right from this month. So I started counting the quarter from here and choose the 3 to 4 month range from here to here, because that is where the bearish price action happened. It started from there and it kept going on for the next 3 to 4 months, right? You would look for specific profile and order flow of price action with at least 3 to 4 months of time window to expect or anticipate a quarterly shift. As I said before, they're not linked to calendar quarters, but rather price quarters, meaning whenever a specific profile or order flow start taking place, right? That's how you're gonna determine or gauge your quarters. Based on this price action right here, you can see that right from the start of this month, we had this bearish order flow, and since the last 3 months, we've been consistently forming bearish price action. So now based on quarterly shift, we can expect a transition or a shift in structure and order flow right here, right? But obviously you cannot use it alone, and you must integrate the other concepts to make that decision, right? And right here you can see that from October to December, right, we know that EU is seasonally bullish according to the seasonal chart. So we're going to combine that idea and add it as another confluence and factor for expecting higher prices. And then right here you can also see that with this bearish price action, we took out this range low and had a turtle soup. So there is another factor that we added to expect higher prices, and then combining all of them together, right, along with knowing that we also tested a higher time frame key level right here. So based on all of these factors combined with each other, we can anticipate, and we would have anticipated a bullish quarterly shift right here. And you can see price did indeed form the bottom here and had a bullish quarter after that. You can also see a CRT there which formed the bottom. Moving on, another most important factor, actually the most important factor in concept to combine with quarterly shift, is SMT divergence, right? We all know that SMT divergence is basically a discrepancy in price, and it suggests a non-symmetry in price or non-symmetrical market conditions, right? And we also know that non-symmetrical price action represents that the current order flow is now unable to continue, and we are likely going to shift and transition into another structural order flow or market profile, right? Now, the best quarterly shift occurs when there is a major SMT divergence present there with a correlating asset, right? Which confirms the quarterly shifts even more, because now that there is a non-symmetry in price, the current order flow is now unable to continue, right? And the odds of a quarterly shift happening increases even more. And then if you can combine it with the seasonal tendency here as well, then the approach is going to be much more accurate, and then you'd be analyzing the higher time frame in such a logical fashion and manner, right? And you'll always have your analysis correct, and your directional bias would be on point, right? You'll be as accurate as it gets. Now, as I said before, quarterly shifts are most effective when combined with seasonal tendencies and SMT divergences, right? Just like I said, you will notice that more often than not, a quarterly shift occur in the presence of an SMT divergence, right? And in the presence of an SMT divergence increases the odds of a quarterly shift happening even more. For example, if the last 3 to 4 months have been bearish, and then right at the end of that time period, you see a major SMT divergence in price with a correlated asset, and also the key levels and seasonal tendencies are matching with each other as well, then the quarterly shift is highly likely, and price can transition into a different order flow or price, and you could expect at the top or bottom to be formed with a great deal of accuracy. Right here we've got this monthly chart of Euro USD, right? It's a monthly chart, so each monthly candle represent 1 month, right? Which means that 3 to 4 candles makes up 3 4 months, right? And the gray quarter right here, you can see that the 3 to 4 candles were all bearish, right? Which essentially means that these 3 to 4 months price was in a bearish order flow, right? And the order flow was bearish. What you can also notice in these 3 to 4 months is that price tested a key level in the form of this order block, and also along with that, we also have this SMT divergence with a correlated asset DXY. So we've got three factors now that are signaling towards bullish price action. First of all, the last 4 months were bearish, and a quarterly shift is highly likely to occur, right? The next factor is price tested a key level, and then the most important factor is that SMT divergence, right? So based on all of these factors combined, we can anticipate the current order flow to unable to continue, and we can expect it to have a quarterly shift or transition into a bullish quarter. And right here you can see that that's exactly what happened, and price turned bullish since that and had this 3 to 4 months of bullish order flow and bullish price action, right? And that way you would have had a correct directional bias for these 4 months, and your analysis on the higher time frame would have been correct and would have been on point. Right here you can see the DXY chart and the SMT divergence that I had with euro dollar. Moving on, here we got another example of quarterly shift combined with SMT divergence. You can see in the gray area we got these 3 monthly bearish down close candles, right? Which means that we had 3 months of bearish order flow. And according to quarterly shift, we know that a market never moves in a specific profile for longer than 3 to 4 months. So according to that idea, we can expect a quarterly shift to occur and a transition for price to occur into bullish price action, right? Now obviously using this idea alone wouldn't be enough, right? So we're going to combine the other concept as well to see if they support it or not, and if they do, we're going to use that to generate this new trading idea and generate a new directional buys for the next 3 to 4 months. What you can see right here is the end of this quarter, we had this SMT divergence with DXY, which means that we had non-symmetry. And what happened is that DXY took out the high it formed, but EU struggled to take out this low, which means we had an SMT divergence and a discrepancy in price. And because of that discrepancy, price showed non-symmetry. And then combining it with the idea of quarterly shift concept, we would have expected and anticipated a quarterly shift to occur, and you can see price did indeed had a shift for the next few months. Right here you can see the DXY chart. It did took out the high and had a turtle soup, whereas EU didn't. So that means we had a SMT divergence, and it supported the quarterly shift. As I said before, all of these are the different steps of the same process, right, that you would be using, and that this is exactly how you would use all of these price action in a logical framework and a logical fashion, right, to expect and anticipate quarterly shifts and use the time concept like quarterly shifts and seasonal tendencies to time the markets in terms of structural order flow and market profiles. You can see that now we are using time to accurately mark tops and bottoms with a great deal of precision and accuracy, right? We're going to be using all these concepts like SMT divergence, seasonal tendencies, daily ranges, market profiles, and key levels to form higher time frame biases and trading ideas, right? You would be using all of them in such a logical fashion, and that will make sure that you always end up having a good accuracy. And by doing all of this, you will always make sure to end up on the right side of the markers, and you will always maintain a strong directional bias, right? This approach will help you build the most accurate higher time frame narrative and directional biases. Moving on, right here you can see this if and then logical process right here, right? And you're going to use this concept exactly like this, right? First of all, you're going to look at the if factors. So for example, in this one you can see if the last 3 to 4 months were bearish, if the last 3 months had an expansion profile, and if there is a major SMT divergence and discrepancy and non-symmetry in price, and if the next few months are seasonally bullish, and if we have tested a discount key level, then based on all of these factors and these aspects, the most likely outcome for price is a reversal profile with bullish price action, right? You can see it's simple and effective, right? You're going to use this if and then logic to form or to generate trading ideas, right? You have to use the correct framework and use it logically like this, right? This is the most effective approach to do it.